All right, good afternoon, everyone. I think we'll get this started as people continue to join. I want to thank you all for joining Horizon Payroll, Brixey and Meyer, and Pickerel, Schaefer, and Ebling, and helping give a little clarity to the very confusing world of the PPP and CARES Act. We have an hour presentation. We hope to break it up into 20-minute segments to leave 20 minutes at the end for any questions. And you'll see down at the bottom of the bar there, there is a Q&A tab. So if you click on that, you can type in your questions. So at this point in time, I'd like to introduce our two panelists. We have Alan Greenwell from Brixey & Meyer. He is a managing shareholder and is down in the Cincinnati office. And Christina Curry, who is a labor attorney at Pickerel, Schaefer, and Ebling. So we're going to start off here with Alan. Alan will be helping us understand some of the monetary components to the PPP.
Great, Scott, thank you. Welcome, everybody. We're going to go through today more around the loan forgiveness process now that most of the folks on this call have probably received their PPP loan proceeds. And so we want to go through that process and some of the nuances attributable to determining the amount of the loan forgiveness, the records that will be required to be kept, and then your kind of confirmation at the end of the term of the PPP loan, what you're going to have to report out to your lenders. We're also going to touch on a few recent Q&As that have impacted this process along the way as they continue to come out daily, as recently as yesterday. So we'll touch on all of those things. Bridget, can you forward the next slide, please, or give me access to do such?
Alan, I just wanted to let those people know who might be still in the process of joining. We are recording this, so if you miss anything in the beginning, don't worry. We will have a recording out to you within the next day.
Great, thanks, Scott. So just we're going to start at a very high level, 10,000 foot. For loan forgiveness, as many of you I'm sure have seen, is that once you receive the PPP loan proceeds, you have 8 weeks from the date you receive the funds in your bank account to use those funds for both payroll costs, which I'll define here shortly, and other costs, which I'll also define here shortly. 75% of those loan proceeds, 75% or more, must be used for what they call eligible payroll costs, which are basically wages, tips, commissions. Included in that definition are any employer-paid insurance premiums, health insurance premiums paid on behalf of their employees, any retirement benefits paid on behalf of their employees can be included in that calculation for our payroll costs. For those that are self-employed, whether they're filing a Schedule C or they are an independent contractor, their eligible payroll cost would be, in the case of a Schedule C, whatever income they earned during 2019 based on their Schedule C. For independent contractors, it would be whatever their income was, wherever they report it from a schedule, from a 1099 perspective. Ineligible payroll costs include compensation paid to employees located outside the U.S. There is a cap on annualized compensation, so anyone making over $100,000 would not be eligible. Those costs would not be eligible for part of the loan forgiveness, and so you'd need to prorate that. Next slide, please. With respect to the other costs, up to 25% of those costs can be used for what they call eligible non-payroll costs, which are interest payments on existing mortgages, rent payments, utility payments, interest payments on any other debt obligations. Now, each of these items must be related to contracts or agreements that were in place prior to February 15th, 2020. So that is an important date that you'll need to determine. So when you look at loan forgiveness, 75% or more of the loan needs to be used for payroll costs. 25% or less needs to be used for these other eligible non-payroll costs. So now we're going to get into really what I would call the guts of the discussion today, which is how much of the loan will be forgivable, or said differently, how much will not be forgivable. When you look at receiving the PPP loan proceeds, to the extent you were to use them for anything other than the eligible payroll costs that we defined, or any of the eligible non-payroll costs, that portion of the loan would not be forgivable. There's also two other tests that we're going to spend the majority of our time on. One is a workforce reduction test, and one is a salary level payroll reduction test. And so you have to look at both of those and determine if any portion of the loan could be deemed to be a loan and not forgivable. So next slide, please. Thanks, Bridget. So we're going to go through an example related to the workforce reduction, and it's very mechanical. I think this one is the easier of the two to understand. We're going to come up with a numerator and a denominator, and if it is less than 1, a portion of that PPP loan proceeds will be deemed to be a loan and non-forgivable. So when you look at the baseline or the denominator, you can choose the lesser of either your average FTEs, full-time employees, between 215, 2019 and 630, 2019, or the average FTE between 1/1/2020 and 2/29, 2020. So you've got the ability to take the lower of those two, and that would be your denominator. Your numerator then becomes your average FTE during the 8-week period. The 8-week period has also been referred to as the covered period, and that is the date that you received the loan proceeds in your bank account 8 weeks forward. So in this example, we would take the lesser of the two for our numerator, and as our denominator, and then we would look at our average FTE during the 8-week period. And because it's less than 1, a portion of that loan becomes is not forgiven. Pretty straightforward on this particular calculation. So then the second calculation is on the next slide. Let me make just one more comment before we go to the second calculation. Recently, this past, I think Friday it was, Q&A number 40 came out, and it talked about with respect to employees who you did let go, or you told them to go on unemployment, and then once you received the PPP loan proceeds, you wanted to hire them back. And because the current unemployment benefits that are out there, which Christina will touch on in much more detail, oftentimes are greater than what they were making when they were working, we've had employees decide not to come back or decline the offer to come back. And so the question becomes, how does that impact the previous calculation we went through? And does that impact our forgiveness? And the answer is no, it does not, as long as you have the right documentation in place, demonstrating that you did extend an offer for employment. They, in writing, did not or declined that particular offer for employment, and you'll need that documentation in order to support your loan forgiveness calculation. So that is something that very recently came up and has been a common question. So let's go on to example 2, which is a little bit more of the challenging one with respect to salary payroll level reductions. So you could further reduce your loan forgiveness amount if during the period of time that is defined, which is February 15th, 2020 through April 26th, 2020, if you reduced pay by more than 25%, and that's only attributable to employees making less than 100. So if you have your top level executives making more than 100,000 on an annual basis, and you reduce their pay by more than 25%, this calculation wouldn't apply. It's only for those making less than 100. So in our example here, assuming our salaries prior to what I'll call COVID-19 were 300,000, our average salaries, and we or the company does a reduction of 40% during the period February 15th, 2020 through April 26, 2020, that difference between 40% and 25% is 15%. That is applied to your wages that you reported on your application, your average wages, and that portion would be a dollar reduction of your loan amount that would be forgiven. There are some relief points, so there's an ability to avoid both calculation 1 and calculation 2, which we'll go to the next slide, which is also in the note on this slide, but we'll get into more detail on the next slide. Great, so how do we eliminate this reduction? So before we even get into it, from a intent perspective of the Treasury and the SBA was for companies not to lay off folks, to keep them on their payroll and continue to pay them a fair wage or a wage that was close to equal to what they were making. And so if you want to reduce, if companies had to reduce their headcount or had to reduce wages, because at the time there was so much uncertainty and their business had gone significantly south or down, many companies during this period, February 15th through April 26th, made some of those tough decisions. And so the government came out with the PPP loan and said, look, we'll provide proceeds for you that should take you through really 8 weeks and help you fund those payroll costs. We want you to keep your head count at the same or higher level and your wages at the same or higher level. If by chance you could not do that because your business did not come back during the 8-week period, you still have up until June 30th, both to increase your head count back to your head count that was pre-2/15/2020, and you have the ability to increase your wages by June 30th in order to avoid the decline or the reduction in your loan forgiveness. So 2 favorable tests, but it does provide you a little bit more time to get your headcount and wages back to those levels. Many of those folks on the phone today, if you already have a loan, your 8-week period is going to end before June 30th. So it's possible you won't get to the headcount level. Just know that you have until June 30th to get it to where you need it to be. Next slide, please. So with respect to the loan forgiveness, the lender who provided the loan will be ultimately the entity that's going to request all of the documentation that you're going to need. The CARES Act defines very clearly the documentation that needs to be provided. I would just caveat that the banks are going to likely ask for more, just as they did during the loan process. Every bank was a little bit different. But as you can see on this slide, here are the items that the CARES Act specifically says you'll need to provide. And that's just verifying the number of FTE employees on payroll and their pay rates for the baseline period and the 8-week period. Payroll tax filings to the IRS, just like you did during the application process, your Form 941s and 940s, any of your state income, payroll, and unemployment figures, documentation around your other payroll costs, which would be just any support of your utility payments, your bills, transcripts, any documentation from your health insurance provider documenting the insurance premiums, and also any retirement contributions that you made. You're also going to have to provide certain certifications, very similar to the application that you filed when you applied for your loan proceeds. So next slide, please. So again, this is a little bit repetitive, but how and where do I request the loan forgiveness? You're going to request that, or you're going to send that information to your lender. The lender will come out with guidance at some point on what they expect to receive from you to support it. Is it right after the 8-week period? We haven't heard, we don't know. If you talk to most lenders today, they'll still tell you they're not exactly sure what they're going to be asking for, other than what's specifically laid out in the CARES Act. One thing that the CARES Act does specifically state is that the lender has to make the decision within 60 days of providing those documents. So next slide, please. So there are some important dates, and I just want to go back, through these important dates and what you should be, kind of making sure that you have awareness of each of these. The 8-week period, there was some confusion there, although it's very clear in the Q&A that has come out. It commences on the date you received the loan proceeds, not the date the loan was approved. Oftentimes, there's several days in between those two dates. The interest on the loans, albeit 1%, accrues from day one. However, all payments are deferred for up to or at least 6 months. The loan term of the loan is 2 years. Probably the most important date in my eyes is this June 30th date, which we addressed earlier, in that you have the ability to restore your full-time employment and salary levels for any changes made between February 15th, 2020 and April 26th, 2020. And there are no prepayment penalties. So next slide. So I want to touch on FTE and what that means, because it's actually defined now in Q&A 36, and it's actually different for when you applied for the loan than it is for how you determine an FTE for the loan forgiveness calculation. So it does make a difference. And so I just want to make sure that everybody understands that when you look at it, when you looked at full-time employees, when you were applying for the loan, the PPP loan, it was defined as full-time, part-time, or other basis. And so in this particular example, if you had 200 full-time employees and 50 part-time that only worked 10 hours each, for purposes of the head count that you would have reported on your application, it would have been 250 employees. Next slide. So kind of part two of this Q&A 36, number 36, is that they define for loan forgiveness that a full-time employee is determined more by the number of hours and not being a part-time individual. So, so you got to look to what they define as a full-time equivalent, which basically is 30 hours a week. So it's a little bit trickier. So if you go back to the previous example where we had 50 employees at 10 hours each, although that counted as 50 employees for the loan, that would only translate into roughly 17 employees for our forgiveness calculation. So there's a little bit of a disconnect there. And I would hope or expect that the Treasury will come out with some kind of remedial kind of correction to this particular issue, because it does give us a different answer. And so in theory, you could have, if you go back to the denominator is based on a bigger number because it has no limitation. It doesn't have the 30-hour limitation, whereas under the loan forgiveness, it is a 30-hour test. So you'd have to take 3 of those 10-hour employees to make up 1 FTE, whereas under the loan process, that would be 3 FTEs. So I just point that out to this group because it is a little bit of a subtlety that needs to be determined. Lastly, independent contractors do not count as employees for purposes of a loan forgiveness. So next slide. So you've probably have all seen or have heard most recently in the last week or so about the need to have necessity of PPP in good faith. When each of you applied for it, you had to assert, you had to make certain assertions that you needed it, that you were impacted by COVID-19, that it was instrumental in keeping your employees or bringing your employees back. And so what came out after the first round of PPP loan proceeds were issued there were entities like Harvard University, the Los Angeles Lakers, Shake Shack, other large institutional entities that received money that obviously didn't create the best of PR. And so the Treasury got pretty adamant that, look, you really need to be able to prove you need it. And you need to be able to prove that you don't have other sources like a Shake Shack who's public, where they could, in theory, go to the public markets and raise more equity. or Harvard, who has an endowment of billions and billions of dollars. And so they came out specifically with a Q&A to address this issue. Originally, when they came out, they were giving companies like Harvard and other entities, I should say, like Harvard and the Lakers to return the money. They had till May 7th. There was a Q&A that came out last night, number 43, that has extended that date 1 week. So the 14th, so a week from tomorrow. So I bring this up because I think it's going to be important for the folks to document why they needed the loans, why they're, whether or not they had other access to capital, and those types of things. There's been no specific guidance issued by the Treasury, but I'm going to share with you today some of the things that we're beginning to tell our clients to think about documenting today, real time. So let's go on to the next slide and we'll start talking about a few of those. So this is just Q&A 31. This is the one that came out around the necessity of good faith. I think the thing that I would point out in this is just the highlighted piece, or the one in parentheses, is that you certify that the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. In that you certify that you didn't have access to other sources of liquidity sufficient to support the ongoing operations that would not be significantly detrimental to the business. Again, no guidance on what all that means, other than I think we'll talk about some document or suggested documentation you might want to think about putting together. Next slide, please. So from a good faith to documentation perspective, what we've shared with many of our clients is that they should look to put together financials kind of when the beginning of the loan and the end of the loan for comparison purposes. What did the financial picture of the company look like, kind of when they received the loan proceeds to the end of the proceeds. They should also consider just modeling the impact of the pandemic for three months, 6 months, a year. None of us on this call or webinar have any idea how long this is lasting. And so I think the fact that companies kind of model out over the next year what they believe the impact of the cash flows will be in projection of uses versus cash receipts, kind of what that impact is on their business. You also want to think about, if you were to go to outside sources, so you didn't go for the PPP, but you went to a bank, how would that impact your bank covenants? Would you even be able to get additional monies because of your bank covenants? Just all the things that you'd want to think about documenting why this PPP loan was really one of the few choices, if not the only choice that you had. Next slide. These other points, and I'll go through them pretty quickly, will just be documenting the impact of the pandemic on your industry. There may be articles out there specifically around your industry. I think the easy one to pick on and see would be, the restaurants or the salons, or the hairdressers, very significant impact on them. How has it impacted your business specifically, I think is important. I think how it's impacted your supply chain. We have many clients that certainly have had their supply chain disrupted, particularly if they're coming from the Far East or even Europe to a certain extent. Documenting, kind of how this has impacted the management team and your employee flexibility and the inability to come into work. Just really documenting kind of the impact of this pandemic on your business, again, to show that really the PPP loan was really one of a only way out, for lack of a better term. So next slide. So one of the things that, as we wrap up on this piece, is that when the PPP loan program came out, it was very clear up front that the loan proceeds received would not be subject to taxable income. And that is still the case. However, the IRS did issue Notice 2020-32 on April 30th, and it basically says, yes, although the loan proceeds aren't taxable, the expenditures attributable that are being paid by the loan proceeds are not deductible. So all of those payroll costs, utility costs that you're paying through the use of your PPP loan proceeds will not be deductible. There is some precedence from a law perspective from an Internal Revenue Code. I'm not going to get into that, but at this point, that is the guidance that's been issued. There has been a lot of pushback on this particular one, in that the intent was to help companies out, small businesses out. They've effectively put them on equal ground now that, yeah, we helped you, but we're not going to give you the deduction. So there could be more guidance here. We don't know, but time will tell. But you can imagine many folks that have been recipients of this went into this thinking that it was not taxable, and that's the end of it. Not that there would be no deduction. So next slide, please. Okay, let me just wrap up before they turn it over to Christina. The one thing that I strongly suggest all of you or each of you on this call to do is begin modeling out, if you haven't already, your forgiveness calculation. And I would do it by week and just make sure you understand how much of it will be forgiven. I will tell you, I would say 75% of my clients have a portion that's not forgivable, maybe even a little bit higher. And part of it is just because of the way the calculations worked when you figured the loan versus how you do the forgiveness. And so I just caution anyone on this phone that hasn't gone through, or on this webinar that hasn't gone through that process, you should do it. You should work with your internal team to go through that calculation, or you should work with your outside providers. But I think it's a worthwhile exercise, because the last thing you want is to have a surprise at the end of the 8-week period and think that more of it was forgivable than not. Because at that point, you're going to have to make a decision. Do you pay it back, assuming you even have the money, or do you realize you've got a loan that's at 1%? So those are my parting comments. Thank you for your time.
Okay, we're going to go to Christina here in just a minute, but I did want to let everyone know we are an Ohio-based company, and most of our clients are Ohio-based. But I will tell you that a lot of what Christina is going to tell you about unemployment and bringing your employees back will pertain to a lot of the states. So hopefully this guidance that Christina is going to give you on unemployment compensation will help everyone.
Great.
Okay, Christina. Yep.
Thank you. Good afternoon, everyone. I wanted just to talk a little bit about bringing employees, bringing workers back, getting open for business again. If employees have been laid off or furloughed, in keeping with the guidance that employers, if they took a PPP, they won't be penalized for employees who are refusing to come back to work. The one thing that you want to remember, however, is that there may be COVID-related reasons why they can't come back to work. So there's that to keep in mind first off. But you should most likely, in keeping with needing the documentation for that so that you won't be penalized, and also best practices depending on the size of your business. And how well you've kept in touch with employees who have been on furlough or laid off, you probably want to give them something in writing, and that would just be something in writing that you offer them their job back, because while they've been off, they may have obtained other employment with businesses that have not been shut down. So give them a letter, let them know the exact date that they would be returning to work, let them know if there have been any changes in the terms and conditions of their employment. Another good best practice would be just to outline the safety measures that your company plans to be taking, and the new rules of the road, whether or not your employees will be wearing masks, and all of that information, hand washing, cleaning and sanitizing, just to reassure them that they're coming back to a safe workplace, and that you're complying with the rules regarding that situation. Being concerned about employees not returning to work when they can come back in terms of the PPP, you will not be penalized for that, but on the other hand, you may want to think about contingency plans in the event that that does happen. So going to go to the next slide, and we wanted just to touch on a program that's available in Ohio if you are not taking advantage of the PPP or cannot. The Shared Work Ohio program is a voluntary layoff aversion program through the Ohio Department of Job and Family Services. It will allow workers to remain employed, but let's say that you want to bring back the workers, but you don't have full time for them, and you can take up to a 50% reduction off of the workers' time in order to retain workers who are trained when you have reduced business activity. Under the Shared Work Ohio or SWO plan, you would reduce your employees' hours in a uniform manner, so sort of an across-the-board reduction in hours, which can change as business picks up. Participating employees will then work reduced hours each week, and the Ohio Department of Job and Family Services would provide eligible employees with an unemployment insurance benefit along with that's proportionate to the reduced hours. So that would maybe be an option. Now, if you're trying to meet a level of PPP forgiveness, then it could be that this program isn't for you. But in the event that you want to start bringing people back at a reduced number of hours until business picks up, you can also look into this program. What you would need to do is submit a list of participating employees, and you'd specify their normal weekly hours, pre-COVID-19 weekly hours, and that would not exceed 40 hours, and it also would not include any overtime that they were accustomed to working. Part-time employees can be eligible, but all employees in the affected unit must have their hours reduced by the same reduction percentage, which can be 10%, but no more than 50%. So the eligibility requirements are that for that program, if you're interested, it would be that you would designate at least 2 employees for each affected unit, shift, or department, and uniformly reduce their hours 10 to 50%, up to 50. You would need to estimate to the Ohio Department of Job and Family Services the number of employees who would have been laid off without the participation in the program. There's some other requirements too. You agree to provide information to ODJFS promptly. You pay your employees hourly, so if they're salaried employees, in this case, you would need to convert them to an hourly pay. And then you would need to be current on all your unemployment insurance reports, contributions, penalties, and interest. So you do have to be current with the unemployment insurance side of things. To apply for a Shared Work Ohio plan, you would go to unemployment.ohio.gov. You would log into your benefits account. From the main menu, you'd select View and Manage SWO Plans. And currently, ODJFS is committed to deciding these applications within 1 week. Normally, that processing time would be 30 days. So there may still be some delay out there in doing this, but they're saying about a week. So they've shortened up the application processing time for you on that. And then there's some important links and places where you can go to get further information on that program. So it's just another option if maybe you're still waiting on PPP funds, maybe you're uncertain as to whether you're going to receive the loan, maybe this is something you can consider as a backup plan. Another aspect of unemployment in Ohio is that in Ohio we have the regular unemployment system, and we have some specific requirements to meet eligibility for unemployment. The Federal CARES Act loosened up some of those requirements and allows for an additional benefit of $600 a week. Now, in the beginning, Ohio was not set up to be able to handle the volume of claims or that type of benefit eligibility, because there are expanded instances where people can qualify for unemployment under the pandemic unemployment assistance. Currently, and this is happening to your employees, is that they are currently pre-registering for this new unemployment benefit, and this is not going live until mid-May. So when you think about, you know, the people that you want to bring back to work and the fact that they are waiting until mid-May in some cases to be able to receive any unemployment compensation in the case of a COVID shutdown, for instance, or if they've been one of the many people who have tried repeatedly to reach unemployment, because right now it's very difficult to get anybody on the phone there. And this may be another consideration, which motivates your workers to come back to work in the event that they were considering staying on unemployment for any length of time. The benefits for the pandemic unemployment, the eligibility is a little bit different from regular unemployment. To be eligible for the new pandemic unemployment assistance, you must not be eligible for the regular unemployment benefits. And you need to meet one of the following circumstances, and they're just listed there, but basically they're all COVID-19 related: experience symptoms, diagnosis, caring for a family member, also a child or another person in the household for which the individual has primary caregiving responsibility, is unable to attend school, or another facility is closed due to COVID. Further requirements or eligibility is that the individual is unable to reach the place of employment. They're very broad, by the way. Unable to reach place of employment, scheduled to commence employment. And with this, we're seeing a lot of seasonal workers applying for unemployment based on potentially that they had expected to come back to work as a seasonal employee. So you may be getting applications based on seasonal employment. The individual's the breadwinner, or, you know, here's one that's very broad, is that the individual has quit her job, his or her job, as a result of COVID-19. So all of these are reasons why the person would qualify for pandemic assistance. And at that point, you know, they may be making more, or, you know, breaking even versus coming back to work for you. Now, the way that it ties into documenting for the PPP is that you're sending a letter to them and you're offering them work, and you're offering them a start date and to come back to work. And one of the requirements for unemployment is normally that you need to be willing and able to look for work and be available for work. One of the things that you could do as an option is just, you know, make the employee aware that you're offering work, but, you know, if they don't want to come back to work, they may be ineligible for their unemployment benefits, unfortunately. And that may be something that you would wish to inform ODJFS or the unemployment regarding their offer of work and their refusal. So it's going to help you in two ways. That way, first of all, you won't be penalized on the PPP, and second of all, you're going to provide the worker with that extra incentive of, you know, potentially losing unemployment benefits if they are refusing to come back to work. You want to be kind of careful when you're making decisions about bringing people back to work, and this is something I just wanted to mention today, is if you were subject to the Federal WARN Act, having more than 100 employees, or any of the mini warns where you needed to give notice, you probably didn't have to give notice when you laid workers off, because you were laying them off for reasons that were unforeseeable. But there is some talk, if you're taking a PPP, but you don't know if you're going to be able to maintain that level of business in the future, that the fact that you may need to lay them back off again, there may be an argument that at this point it might be foreseeable this time around. So that's something to keep in mind. And if you are in that situation, to consult with your attorney. So I think that basically describes the unemployment and bringing people back to work. And I guess we could get to questions at this point.
Okay. Again, want to thank our panelists. I hope everybody's been informed. I know we have a ton of questions, and again, we won't be able to get all of the questions because there are over 100 of them. So we're going to kind of pick and choose those that we think are germane or are important, and answer those. So. And the balance will be sent out at a later time. The first one, a lot of people have been asking, can they go back in time and pay, let's say, their March rent? Even though they got the money now, can they use that to pay any back rent or any back expenses that they have?
Sorry about that. So a couple of things. One is, as long as the rent agreement or lease agreement was in place prior to February 15, 2020, if they're making payments during the 8-week period, they should be able to use those PPP loan proceeds to pay that rent during the 8-week period. Keep in mind that the other eligible costs, non-payroll costs, cannot exceed 25%. So although you can go back and pay back rent, at least based on the guidance today, there's always the risk that the government could come in and say it has to be only rent going forward, but that has not been the case. I know one of the other issues, the common question, and I'm sure it's out today, is, are we paying on an accrual or cash basis? So let's just say we get a loan on Wednesday and we pay payroll every Friday, and we pay payroll on Friday, 2 days after receiving the loan proceeds. Does it go for the full week or just the Wednesday, Thursday, Friday payroll, the day we received the loan? There's been no guidance. And so what I'm suggesting to companies is just track it. And because you're going to have that situation not only in the first payroll, but the last payroll at the end of the 8-week period, where there's going to be some of that payroll that is outside the 8-week period. So there's been no guidance on cash versus accrual. So hopefully I answered 2 questions there.
Yeah, you sure did. That was the next question I was going to ask you. But do you recommend a separate bank account for these things to be for this 8-week period?
Not necessary, and most of the lenders aren't requiring a separate bank account. I think the key is just to keep or track your expenditures that you're using the PPP loan proceeds for.
A lot of questions about utilities. Help us define the word utility. I know trash removal has been one of the questions. So what kind of guidance could you give, even though there probably isn't a whole lot of guidance on utilities, but why don't you tell me?
Yes, so the law, which came out, when the CARES Act came out back on March 27th, says that covered utility covers the distribution of electricity, gas, water, transportation, telephone, or internet access. Trash specifically is not mentioned in the definition of covered utility. So I would just suggest at this point, based on what we know, and the law will dictate, unless they come out with an interim final rule or a Q&A, that trash would not be a qualified utility payment. It would just be kind of electricity, gas, water, transportation, telephone, or internet access.
I think this will be for Christina. Christina, if a full-time employee is now part-time, will they be eligible for the $600 federal unemployment?
Uh, they have not started to process these applications yet, but there is normally a reduction taken if there is a partial, if there is still partial income. There is a reduction, and it's based on a lot of different things, including the average weekly wage that's calculated based on the total income in the base period divided by 52. If there is a reduction calculation with the PUA, I have not heard of one yet, but they haven't started to process those. I believe it is the benefits that you're entitled to plus an extra $600, flat $600.
Alan, can I use the PPP money to pay employees a bonus retroactive for continue to work during the
Yeah, the answer is yes. Based on the guidance today, there's no prohibition from you paying a stay-on bonus or a bonus for previous work that's been done. I think when you look at the spirit of the program, it was to keep employees on and pay them equal to or more than what they were making prior to COVID-19. So no concerns on the bonuses, other than just keep in mind you still have this $100,000 cap per employee.
How do I figure out what I will call the safe harbor provision that allows you to get your FTEs and salaries back up to the February 15 level by June 30th? Does it have to be both FTEs and wages? And what is the measurement and the specific dates?
So the forgivable loan calculation has two calculations. One is FTE and one in salary level. So the answer is yes to that. You need to get both up. You don't have to. If you get one up, then you only have one that you got to worry about from a forgiveness perspective. June 30th is the date. And so anytime before June 30th, but June 30th, the way the law is written, is the date. You need to have your FTEs back to that point and your wages back to that level. And you're comparing that to whatever. So really the date that you're comparing that to is kind of 2/15 or prior to that. Many folks filed their applications based on calendar year 2019. So it's likely you're comparing that to calendar year 2019 average wages that you reported on your application.
Alan, I know you talked a little bit about this, but somebody had asked about the loan forgiveness to self-employed 1099 employees. I don't believe they're considered in the calculation, are they?
So there's been no guidance on the forgiveness piece. The loan piece was just based on your Schedule C, again, capped at 100. But the thought, or at least the I'll call noise in the system, is that during the 8-week period that you have received the PPP loan proceeds, you're going to look at your Schedule C net income, and it's intended to cover the same cost. So your payroll cost would be whatever income you make from the Schedule C during that 8-week period, and then you also can pay the same type of other non-payroll costs. So the calculation works similar. You just got to look at your Schedule C during that 8-week period, and assuming you make a similar amount of money based on what you used in the previous year to determine your loan amount, you should be okay. But there is no specific guidance out there, but that's our interpretation of it today.
Christina, do you feel like they're going to be able to use the PPP funds for work comp premiums?
So right now in Ohio, workers' compensation premiums are deferred for the months of March, April, and May, and they're deferred until June. I think that in terms of using PPP funds for that expense, Alan, do you think that would qualify as an expense? Because I don't know that I see it would be an insurance expense.
Yeah, for whether that's an eligible payroll cost.
Yeah, well, it wouldn't be an eligible payroll cost because at least in Ohio, we aren't charging, it's not considered in our payroll costs. It's more of, it's based on payroll, but you don't pay premiums as part of, it's not really tied to payroll. It's not really tied to a salary. So it would be more like an insurance payment, a premium on insurance.
Yeah, so I don't think that qualifies definition.
Yeah. Yeah, I don't think that it would either. Ohio is, at least in Ohio, there are quite a few programs right now that are taking employers' premiums down to zero. They're also planning to give quite a bit of money back, and they do on a regular basis. So chances are good that, you know, just the past few years, Ohio employers, a lot of them have received an 80% reduction on their premiums through payments made around October of the year. So yeah, I don't think that the premiums are eligible, but I think that Ohio has provided relief on the workers' comp premiums, and I think that, you know, we can expect that they will continue to do so.
I'm still applying, but wondering my 2.5 months of salary would total around 10,500. Am I able to ask for more?
So they're applying for the PPP loan. So it's more than just your 2.5 months of salary. It's plus, assuming you have employees, any health insurance premiums that you paid on behalf of the employees. It's an average 12 months as well, times 2.5. And any retirement benefits, in most cases, 401k matching contributions that you made on behalf of your employees, times 2.5. So it's a little bit more than just your wages.
This person's business is closed. All employees are furloughed. Will the 8 weeks be extended for those businesses that are completely closed? If it is not, how will this loan help me when my business is allowed to reopen? Business will be much lower when we reopen.
Yeah, there's got to be guidance given here. You know, people that have applied for the loan and they receive it, and you're in the restaurant or salon business and you're unable to open, it doesn't seem fair that your 8-week period starts when you receive the funds, because what are you going to do? Hire everybody back and have them do nothing? So I fully expect further, or not just me, but I think the overall community believes that there'll be more guidance issued on this. I do know that Senator Portman recognizes this issue and has pushed very strongly to get legislation to state that the 8-week period for certain businesses shouldn't start until they're back to some normalcy of operations.
Christina, a lot of employers are having a hard time getting their employees back. Can you speak to a little bit about what their role is in helping them understand that if they're offering them a position that they have to come back, because otherwise their unemployment may stop?
There can be a number of considerations, including that, you know, employees are frightened to return to the workplace. And so I think one of the main things that can help them to return is to develop a good COVID-19 safety plan that's in compliance with the federal guidelines, state guidelines, CDC, and to make employees aware that you intend to put that plan into place in order to protect them. I think that may be a lot of it. The other piece regarding that, you know, that they're maybe collecting more on unemployment than they are working. You know, you're just going to have to let them know that their eligibility for unemployment is, you know, generally contingent upon their being available for work. And, you know, when it comes right down to it, you could notify ODJFS and you'll have the documentation that you need to do so. We don't like to do that, you know, so in just a word to the wise, friendly sort of way that you can say, you know, this may affect your eligibility for unemployment benefits if you are refusing work. I think a lot of people understand that. I think there's been a lot put out there just in the past couple of days regarding that as we start to open. But you want to think too about your business plan and which employees you think you can sustain when they come back to work. And obviously with the PPP, you're going to want to maximize that so that you reach that 75% threshold. These are the concerns, but I think one of the main concerns is the safety issue. So we have been putting together COVID-19 plans for employers, and it's worked out pretty well, but it's even something that you can put together. We can help you put it together, and they acknowledge that they received it, and they have the opportunity to ask specific questions as to how this is going to work in their position.
Alan, an FTE is obviously based on 30 hours per week, as it is with ACA. What is a good way to calculate what your FTEs are to take a look at all of your hours on the week of February 15th, not including any overtime, divide them by 30, and that gives you your FTEs for that.
So you keep in mind that the denominator is what your FTEs were when you reported them on your loan application. So those were figured differently than your FTEs for your loan forgiveness. So your loan forgiveness will be based on your 8-week period. So I think there's a little bit of apples and oranges. And again, I think I don't think the Treasury thought that there would be, but there is. And so I think they're going to have to figure out how to connect those dots a little bit better and make sure that we're comparing apples to apples when we do that calculation.
When you talk that, obviously the seasonal businesses that weren't operating in January, February, and even part of March, how are they going to be counted?
So there are specific rules for seasonal businesses. I candidly don't know them off the top of my head, but there are special rules. I'm happy to answer that question when we send out the list of items.
Speak to anyone who is currently making over 100,000 and how much of theirs is going to count. It's anything over 100,000 will not count towards the forgiveness. Is that correct?
Yeah. So you basically need to take the 100 divided by 52 weeks and come up with a weekly salary, and then it's 8 times that weekly salary. That's what you can take into consideration. The 100 only applies to wages, so you can still, so it's the 100 limited plus the health insurance premiums and the retirement benefit contributions are not limited. So it's kind of limit the 100 plus the retirement benefits plus the health insurance premiums paid on behalf. So that is a little bit of a subtlety that you need to make sure you factor in when you go through the forgiveness calculation.
Since we had so many questions, we're going to go just a little while longer, being respectful of your time. If you need to leave, that's okay. We are recording all of this. That will be available sometime tomorrow, and we will be sending the slide deck out today. So I had another question as it relates to FTEs. Somebody on their application for their head count used the average of 2019, and when he looked at his 1/1 to 2/29 period, his head count was down. Can he still use the lower numbers, or is he going to be held to whatever was on his application?
Yes, so he does have the ability, or he or she has the ability to use the 2 periods that we discussed to pick the better answer. Let me just pull that up. So you can look back to 2/15/2019 through 6/30/2019, or you can use the 1/1/20 through 2/29/20. So you do have the ability to determine that denominator, using those 2 periods of time.
Do you feel like I think you spoke a little bit to this, but do you feel like the financial institution of the entity is going to make the?
I mean, they're the ones that are responsible. They're the ones that, even though the SBA is guaranteeing the loan, the lender is the one that's got to make the decision based on the information that is provided by the borrower. So yes, the answer is yes.
Getting back to taxability of the forgiveness, I know that everything that we've seen, it's not going to be taxable on the federal level. Obviously, the rent and the mortgage is not going to be deductible. But do you have any guidance, or have you seen anything about the state or city level?
Not at this point.
Can a company pay a payroll early to stay within the 8-week period?
So again, I think it's going to come down to how they come out with the rules around accrual versus cash. And so if this individual is suggesting that they, before the 8-week period ends, they prepay a couple weeks of payroll, there really is no guidance. However, on the other hand, there's nothing that can prohibit them from paying bonuses before the 8-week period ends. So I don't have a great answer, unfortunately, but I think when it comes to prepayment of expenses in general, I think there's some latitude there for sure, but short of any guidance, I'm not sure I can really give a definitive answer there.
Yeah, I kind of knew that, but I know that was still a question, and I just wanted people who've been asking that to understand that there really isn't any guidance on that. We have a question: if we had 100 employees before the COVID impact and 20 were lost because of the impact, you feel like they have to hire 20 more so that they would get 100% forgiveness?
Correct. On that piece of the calculation, correct. And it doesn't have to be the same 20, but they have to bring back 20.
One thing I wanted just to say though too is, when you're looking at hiring people back and paying them to be non-productive, that also goes into the business decisions that you are making. The worst case scenario is that you've obtained a partially forgiven loan at 1% interest, I believe it is, over the next 2 years. So when you think about bringing people back and getting loan forgiveness, that's another aspect of the decisions that you're making, is whether it's worth it to have people come back and be non-productive as opposed to just simply having that amount of the loan unforgiven, and maybe there are other things that you would choose to do with those funds.
Great, thanks, Christina. I have a question for you. I have 2 full-time staff that are out on FMLA leave due to no childcare coverage with the schools closed. Can I end the FMLA and still pay them the same wages from my PPP funds for the same remaining period of their FMLA 12 weeks?
Well, the new expanded FMLA provision is part of the FMLA, and it's enforced by the Department of Labor. So if someone is taking 12 weeks of leave and they're eligible for that leave, it would depend on what your existing policy said about any type of leave, but I would definitely make sure that you designate the expanded FMLA leave for the parent who is home caring for the child.
Great. Alan, do you feel like the percentage or do you feel like there could be a worksheet created to help people understand the differences in headcounts and how that would affect their forgiveness?
Yeah, so there are several firms, including ours, that have developed spreadsheets. I think the AICPA has developed a spreadsheet to help companies do kind of what if scenario modeling of the 8 weeks. So there clearly are spreadsheets out there to help you or assist you. I mean, my last parting comment when we do end will be, every company on this call should at least be doing some analysis around it, because you don't want the surprise come the end of the 8-week period, or certainly by June 30th at the latest. So the answer is yes, there are definitely spreadsheets out there that can help companies compute or estimate what that loan forgiveness looks like.
Alan, I know the answer to this question, but I still will look for your answer. For the employees that you bring back, can you give them a bonus or a raise within that 8-week span, and it will be considered forgivable?
Yes, I mean, so said differently, you would use your loan proceeds to pay those wages, and so the fact that you want to give them a bonus is perfectly fine. Again, keeping in mind the $100,000 cap, I always want to just make sure people are cognizant of that.
Okay, we want to thank Christina Curry from Brickrow Safer Enabling and Alan Greenwell from Brixie Meyer for their help. They put together this PowerPoint themselves, and I thought it was terrific. We have a bunch of questions that are still unanswered, and we will get answers out to you hopefully before the weekend, and if not, certainly by Monday. Horizon Payroll, we have a product. It's called the HR Support Center. It gives guidance, it gives answers, it keeps up with the state and federal and local laws. We thought that for all of you attending, we would give that out as a courtesy for the next 30 days, let you try it out, see how you like it. And if at the end of the 30 days you didn't feel it was a valuable tool, then you can just end with no consequences whatsoever. So again, that's our HR Support Center, and in order to help you all out with the ever-changing world. So you'll have that in an email also within the next couple of days. If you just to go out, sign up for it, we'll get everything out to you. You can evaluate it and see if it's something that you find useful. So thanks everyone for attending. Thanks again, Alan and Christina. And Bridget, thanks for hosting the webinar. So everybody stay safe out there and have a great weekend.
Thanks.
Everyone.